Hi, and welcome to this special weekend edition of Only Equities and Fixed Income, based on the closes from Friday, February 5th. This is over the weekend, and we're doing so because there were extensive enough implications for both these markets and the foreign exchange, especially in the longer term context, that we felt it necessary to split up these two somewhat more in depth views into separate videos. Now, what was very interesting is how everything acted in the wake of the U.S. employment report on Friday, and we'll get to that momentarily. So we have to ask, what has all this meant to the markets? And the answer is that there have been a couple of interesting responses to things being not quite as strong as the Fed would have expected, which is initially overnight out of Tuesday into Wednesday. The comments about maybe the situation being not quite as strong as expected from New York Fed President William Dudley, typically hawkish individual, at first encouraged the S&P 500 future on the opening to get back up around 1910 or so, and then through the course of the next hour it slipped back below not only settlement at 1897 and key support around the 1895 area, but slid all the way back down to the support around 1865. Now we're going to open this up and highlight that right now, this hourly chart, just to show you the importance of that area, because the 1865 area, after the Wednesday wobble a couple of weeks ago, also on indications of weak commodities and energy that really knocked the markets heavily down into 1804 on the S&P, came right back later that same day due to the expectation the ECB was going to be more accommodative on Thursday, the 21st. And here we were, and they were. So it was kind of an agony on the weak commodities, but commodities and the equities came back on friendly anticipation toward the ECB and left an up break right around 1860. And after the gap up on Friday of that week, January 22nd, even in the wake of the still somewhat hawkish Fed, where right after the FOMC statement was made, that still maintained, in spite of weak factors, they were likely to hike, knocked the market down. It has had trouble getting even back below the top end of 1865 to 60. You know, that's been a key area we're looking at, and we're going to go look at the monthly chart again in a little bit to review why that's so important. And then even this past Wednesday, when it got hit, basically only got back to 1865 before cleaning up again, and on Friday got near 1865. Now, what's important about this for the beginning of this coming week on Monday the 8th is that if you're much below 1865 to 60, the market could be in real trouble again. And the short-term oscillators are below their lower runaway bands, even though the market cleaned up in a minor way on Friday. However, you also left a down break out of the overall gradual upward channel from that low a couple of weeks ago, back on that Wednesday on the 20th, and that downward break was from just about 1876. The tolerance would be this minor high before the breakout at 1884. So with a settlement right around the 1875 area, there's a lot resting on where this market is more than $10 to $15 lower at the beginning of this coming week, in which case the weakness might feed on itself in a fairly significant way once again, or if it's more than $10 to $15 higher, taking away the most recent down break and possibly taking away the overall downward momentum on the short-term oscillator. Of course, there's still plenty of higher resistance up in the 1895 to 1902. We noted coming into Friday, 1895 was the low end of that area that was the key, and once it was below it, you know, this could be a clean out and they'll get back above it, but Friday it wasn't pretty. And there's some new interim level now at 1922, but with the bigger resistances up in the 1925 to 32, 1960 area, and 1970 to 75. And that pretty much does it for the short-term view of the S&P 500. And it is important to look at the monthly chart right now, and that's because you can see the bigger articulation of those key intermediate and longer term levels we just discussed. The breakdown between below 2010 to 20, specifically around 2015, it happens to be the same level on the monthly chart, no aberrations there, was the overall somewhat more aggressive up channel from the significant correction low into October of 2011. That was the whole Euro crisis plus the U.S. failing to pass the debt ceiling limit extension back in August that carried over into a low in October. Very prominent and, of course, held on multiple occasions, including the 1813 low of the Ebola scare back in October of 2014. This line isn't here because this low is here. This support line was there before this sharp sell-off and recovery. Now, it finally broke that, again, up in the 2015 area, and that left it open to filling out first toward, and then actually temporarily breaking down below the 1860 to 65 area, which also happens to be a very prominent Fibonacci level, on top of it being the trading low from back in September after the Fed meeting before the October push up. So a lot of psychology tied in this area as well. To break out below it and recover could mean it's stabilized. To be back below it more aggressively a second time would point towards supports down in the, at a minimum, the old upside acceleration area at 1777, but the Fibonacci area is in the 1760 and 1726, along with this key trading low at 1732, would probably be the targets the next time down. In other words, holding the low 1800s was probably not the end of the break once the market gets in trouble again. And that pretty much does it for the S&P 500.